Hello there, Market Insights watchers. Well, in Market Roundup, is the Fed winning its fight against inflation? Stock investors seem to think so. Find out why. And Tech Megatrends will show an interesting graphic that points out in living color where to invest next in the tech sector. And in Crypto Corner, Ian will answer your crypto questions, including one on Bitcoin mining. So please remember to subscribe and like this YouTube channel, the Bannon Hill YouTube channel. So let's begin. Hi, Ian. Hello. How are you today?
Good, Amber. What's new?
Nothing new. Well, I was on vacation. That's right. But it wasn't really a vacation for me. A lot of productive things to do for the families, but I'm glad to be back with
I
you.
mean, you live in Southern Florida. Every day is a vacation down here, right?
Exactly. That's a glass half full. I love that. That's right, Ian. Okay, so in Market Roundup, we'll start with that. The possibility of a U.S. recession is steadily moving toward the rear view mirror. U.S. stocks are on track for their best week performance of the year after the Federal Reserve indicated that in last week's Fed FOMC meeting, where it left Fed rates unchanged at 5.5%, that looser policies may be on the way and that the US may be heading for a soft landing with a possibility of 3 rate cuts this year in 2024. So as a result, investors turbocharge their appetite for riskier investments like tech stocks. And as seen in this chart, the S&P 500 Information Technology Index continues to outperform the S&P 500. Also, small cap stocks, as monitored by the Russell 2000, got a boost. The Russell 2000 hit a new year-to-date peak. And as Bloomberg Intelligence, or BI, notes, the Russell's, quote, recent behavior successfully holding its 50-day moving average before its most recent breakout is encouraging, end quote. And also per Bloomberg, Gila Guibault, a portfolio manager at AXA Investment Managers in Paris, actually stated the following, that inflation is going down and that the economy is better than expected. So this is the best case scenario possible. The Fed has won its gamble. It's simple as that. So, Ian, I think I know where you land on the topic of the Fed. So, do you feel the Fed is winning?
Well, first of all, I'm impressed by your pronunciation of Gila Guibault, Amber.
It's
If I saw that, I probably would have butchered it. But we spoke about this a couple months ago about this idea that the Fed is landing the plane, but people are saying it's going to be a hard landing or soft landing, or it might not be a landing at all, right? I
sure.
mean, it could be one of these planes that feels like it's coming down and we could have a recession,
Mm-hmm.
but then the plane accelerates. And I think at the time I talked about the story of the plane that I was on. It was a couple of years after 9/11, so people were still hesitant to fly. I was flying into LaGuardia Airport in New York. And I remember it was a very clear night, and we went, past the city skyline on the way in. And as we
Mm-hmm.
were coming down to the runway, instead of, you kind of bracing yourself for the landing,
Mm-hmm.
the engines kicked on again, and we went back up in the sky. And there was no land. Eventually we circled around and landed like 15 minutes later. But for a moment there, we felt kind of scary, what's going
Mm-hmm.
on? Like we were supposed to land
Mm-hmm.
the plane. But what happened was there was a plane in front of us in the runway. But anyway, and so thankfully the pilot went back up in the sky. But
Mm-hmm.
yeah, I mean, this feels like there's not going to be much of a landing. And one thing, Amber, that really stood out to me,
Mm-hmm.
the Fed had a meeting. It seemed like if you look at the dot plot, which is their expectations for where Fed funds are going to be in the next couple of years, has turned a little bit more hawkish.
Mm-hmm.
But the one thing that the market took away from it, and when I like to watch, like I watched the conference and I've got Powell on one screen, and on this screen I have the market's reaction to it, right? Because you want to see like what investors, especially now it's like all algos, like what they're parsing through his words and they're
Mm-hmm.
reacting, buying or selling. And the one thing the market really, really liked was when one of the reporters asked Powell a question about, can you cut rates in the face of continued job growth? And he basically said yes. Like, sure, we can cut rates as long as inflation is coming down, and even if jobs are still increasing, we don't need a recession to cut rates from where they are currently. And I think the market really grabbed onto that idea. And that's when we started to see that post FOMC rally, and the market is up a decent amount. I think we hit a new 52-week high in the S&P 500 and also the NASDAQ. So the last thing I would also as a takeaway is that I was watching the US 10-year interest rate because for a while the yield had been below 4% this year. We started to climb back up. We got to 4.25, 4.3% was really like the breakout. If we get above that, we probably head back to 5, which I think would be negative for the market.
Hmm.
And we didn't get above 4.3. We're back down to 4.21%. Rates are basically where they were. We're kind of like rates have plateaued. The market is doing well. The economy is doing well. And then lastly, you're going to see significant earnings growth from mid and small cap companies this year compared to the numbers there were last year. So the third and fourth quarter, I think, are going to be very, very good for smaller cap companies. The mega cap companies already had their rally. And and just like you were mentioned, like the IWMs I think, are the place to be in the stock market right now.
Okay. Good news there. Okay, Ian. So in tech megatrends,
Mhm.
let's take a look at where to invest next. We're always looking ahead, right, Ian? So,
Yep.
yep. So please,
Always looking ahead, Amber.
that's how we have to function, right? So please check out this graphic, everyone. It's a BI scorecard of the S&P 500 tech industry. Now, this scorecard ranks what tech industries are currently favorable, neutral, or unfavorable for investment. And right now, it's favoring semiconductors and electronic equipment as investments. I'll quote semiconductors, the scorecard's leader is powered by its robust technicals and accelerating earnings trends through relative valuations, though they are appearing lofty. Meanwhile, consensus suggests fundamentals could rapidly turn for electronic equipment amid its low relative multiple, propelling it to the second spot, end quote. And what's interesting is also to note that every tech industry, with the exception of artificial intelligence fueled semiconductors, are trading at a discount relative to their sector right now, Ian. Electronic equipment is currently trading at a discount of negative 5.47, which could place it in a position for gains ahead. And lastly, BI found that consensus anticipates all tech industries, but of course, except for communications equipment, should post earnings growth this year. Their earnings trend score, which quote nets expected average next 4-quarter earnings per share growth against the trailing years, favors electronic equipment up 6,633 basis points and semiconductors up 664 basis points, end quote. So electronic equipment companies like CDW Corp or JBill Incorporated are ranking higher in the BI stocks multi-factor score watch list, which is really a combination of the stock's value. This is what it takes into account: the stock's value, momentum, a low volatility, and profitability characteristics. So what I'm thinking, Ian, I think this data supports your thesis that we may be heading for an uptick in the PC sales cycle. No? What do you think?
Mm-hmm. Yeah, I think so. A couple things going on here. Number one, remember, last year was the tipping point for AI, right? We had the introduction of ChatGPT, and every other mega cap tech company introduced what's called a large language model. The thing we're going to see throughout the rest of this decade is that robotics is basically the physical manifestation of artificial intelligence. So anything that suddenly, these machines have brains, right? So the machines are going to be worth a lot more than they were a couple of years ago. And so you're going to see demand for anything that has to go into the manufacturing process of a machine go up this decade. Now, in terms of specifically the PCs, I believe, and we've been saying this, is that AI is creating a new PC cycle, which means that the PCs move automobiles have a cycle. There's kind of a cycle for everything, right? And the last PC cycle happened in 2020. Okay, 2020 we had COVID. Everybody got stuck at home. Employees had to go home and work, so their businesses were like, "Well, we'll just give you a new PC." The government sent checks to everyone. Many of them went to Best Buy and bought new computers. There were a lot of kids staying home, so they had to have a new computer to do classwork for, and a lot of like younger generations went out and bought PCs so they could do more gaming because they couldn't
Mhm.
go anywhere, right? So they were playing video games. So that was the last PC cycle, started in 2020. At the end of 2022, the market for memory prices, so you have the DRAM and the NAND flash memory market, fell off a cliff.
Mhm.
And I got this from TrendForce that the prices fell for 2 straight years since the end of 2021. But now in 2024, they're predicting price increases in the contract market for DRAM between 13 to 18% in the first quarter alone, as well as price hikes for NAND flash between 18 to 23%. Okay. When I saw that, when I read this in January, I said, Amber,
Mhm.
we got to add one of these memory companies to our strategic fortune portfolio. So we added Micron. The stock just blew out earnings a couple of days ago. It was up, I think, what, 15%. It's up at least 20% or something in the portfolio since we added it.
Right.
So, but this is just the beginning.
Mm.
This is just the beginning of the PC cycle. So any of these companies that are manufacturing PCs or in the supply chain of PCs are going to benefit in the next 2 years because of this demand for AI and the new PC cycle that has just started. So I think that, and you're also seeing it in these S&P 500 technology industry rankings, of course, with semiconductors being at the top of that.
Beautiful. I'm so glad when data supports forecasts. So that's really, really, really good there, Ian.
Yeah, it's like sometimes like in investing,
Hmm.
I read this in PC World. Like,
Hmm.
you're not going to get this news watching CNBC. Like, if you want to stay ahead of the trends, you have to read the industry publications.
Hmm.
You got to read like Nature magazine to find out what's happening in biotech, and you have to read Scientific American and PC World. But these are the things that I know you love to do as well. Is like uncovering kind of these like little hidden bits of information that can add a lot of alpha to the portfolio that the mainstream media net isn't necessarily going to cover because it's such a very niche market. You got to kind of be a little bit more in the weeds.
That's okay. We live in the weeds and navigate through it.
Except
So
in your garden. I'm sure like you probably have no weeds in your front lawn, Amber, knowing you.
we're pretty good. Love gardening. That's my jam, as they say.
Mhm.
Okay, so let's turn to Crypto Corner. Ian, we have a lot of questions, but we want to focus on two this week and anything else you want to cover in crypto.
So much. So the first thing I want to say this week is there was some huge news that happened this week. And remember, we've spoken about BlackRock, right? I mean, BlackRock is a $12 trillion asset manager. Between BlackRock and Fidelity, one of them is usually the king of the asset management business. But BlackRock has been more of an activist in terms of like creating new avenues for investors. They were the spearhead of the ESG movement, and more recently, Larry Fink, who's the head of BlackRock, has basically made the Bitcoin ETF come to fruition. Right? There were for almost a decade now, there were smaller companies that were trying to get a Bitcoin ETF. They couldn't do it. So BlackRock decided, hey, let's do it. Larry Fink came around, woke up one day and said, wow, Bitcoin is a pretty cool thing. Um, let's do an ETF. And sure enough, less than a year later, you've got 11 ETFs approved, all because of BlackRock. Now, what is he doing next, right?
Mm,
Let's think about this because he's going to make things happen in crypto between finance and crypto. And his new thesis or his new jam, let's say, Amber, is tokenization of real
mm,
world assets. And
mm,
you might see this acronym RWA. That means real world assets, which means that anything that you can own can be represented as a token on the blockchain. And you might say, well, why would we want to do this? Well, because the infrastructure of the financial system is very dated. It's like
mm.
having lead pipes. Okay. I mean, it's like 50 years old. And at some point, there needs to be a new way, a better way of doing things, especially in this digital age. Blockchain is really that solution. And so, what Fink is now spearheading is basically tokenizing stocks and bonds,
Mhm.
commodities, uh, real world assets like real estate, which you can fractionalize, and deploying them on chain so they're easier to transact and also track. And what BlackRock announced, and this is like you remember Neil Armstrong said one small step for man, one giant leap for mankind. So one small step, they deployed $100 million fund onto the Ethereum blockchain.
Hmm.
$100 million for BlackRock, that is tiny,
Hmm.
right? But it's a huge leap in the sense that you now have the largest asset manager in the world with an on-chain fund, which is just going to increase over the years ahead, right? So this is like the snowball is at the top of the mountain and has started rolling down. And it's just going to keep getting bigger and bigger and bigger. And I tell people this in crypto, look, like you want to invest in crypto, it's going to be very volatile. We saw prices of Ethereum were above 4,000 last week. It's 3,400 right now. The
Hmm.
path to where this is going to be extremely volatile. But just keep in mind that snowball that's coming down the mountain, right? The crypto is going to eat the whole financial system in the same way that software ate everything in the world over the last couple of decades. And crypto is going to do much more when it comes to, the asset for all digital resources, whether it be cloud computing or network bandwidth or computational power. It's basically coming. It's going to happen. The problem is people who are new to this, they invest and they say, I'm going to put it all in today. And then next week they're down 20%. And it's like, what happened? It's coming. Like this $100 million on-chain deployment of BlackRock
Hmm.
is clear evidence that that snowball has started coming down the mountain. And you can either choose to get involved because this is coming, or, you can say it's just too volatile for me as a class. For me, I just put a small percentage of my investment holdings in it.
Hmm.
I limit myself so that if it goes to zero, I only lose the small percent of my, I don't think it's going to zero, by the way. But, crypto has huge drawdowns.
Right.
And if you want to hear more about also the halving cycle and the places I think you should invest now, please check out our webinar. We launched it last week. People have been very happy with it so far. And that's what's happening in crypto this week, Amber. The snowball's coming. I mean, just wait.
Okay, I'm glad that you have mentioned that, and those who want to get on board, get on board.
Yeah, I mean, you can either be on Larry Fink's team or like
Mhm.
against him, but like the guy makes things happen in the financial world, and like, it's like don't fight the Fed, don't fight the Fink is like my new. Maybe I should get a hat that says "Don't fight the Fink," right? I
Yeah,
think we were supposed to do T-shirts like "Rolling with Larry" or something like that about Larry Fink. No,
why not?
yeah,
We
we got to get on that.
can support that for sure. Okay, Ian. Yes, and everyone, yes, please check out the fourth
Mhm.
halving. We'll make sure to have a link in the description section of this YouTube video to watch it, or in the email that accompanies this video. So, Ian, we have two questions for you this week, all crypto related, of course.
Okay.
The first one is from Jamie. Hello, Jamie P, for writing in. Jamie says, Dear Ian and Amber, I'm a longtime subscriber to various publications at Bannon Hill. I have a
Mhm.
question for you. There are companies who mine Bitcoin, such as Riot, Hut 8, and Hive, whose share prices seem to have gone down, or at least have not gone up with the price of Bitcoin since February 27th, as you commented on your video. It sounds logical that if you are a Bitcoin miner, when the price of Bitcoin goes up substantially, the share prices of the miners should follow a similar course. Could you kindly let us have your comments on this? Thank you.
Well, first of all, thanks for writing in, Jamie. And I would just also have you think about like other businesses where there is some type of mining or extraction process, right? So like in the oil markets, there is the oil, which you can invest in the commodity, or you can invest in companies like ExxonMobil or refining companies, companies that are bringing oil to market. Same thing with like gold and silver miners. There's gold and silver that you can buy, or there is the miners, right?
Mhm.
And when you buy the miners, it adds, and same thing with crypto, it adds just more complexity to it. Okay. So not only do you have to worry about the price of the underlying commodity, in this case, the cryptocurrency, but you have
Mhm.
to worry about what does the balance sheet of this company look like, right? How much debt do they have? How profitable are they? Like how much money is being returned to shareholders, or how much money are they spending on buying new equipment to mine more? The other thing that's going on with crypto that adds us a whole new layer of complexity is like if you're mining Bitcoin, right? And the number of tokens that is distributed for every block that is mined every 10 minutes is 6.5 right now. So 6.5 Bitcoins, times $60,000, which means that you getting like $42,000 is coming from the Bitcoin chain to miners every 10 minutes. I don't know what that is on a daily basis. I can't do
Mm.
the math in my head, but it's
Mhm.
a lot of money.
Right.
But the problem is that on or about April 20th, which is, 4 weeks away now, Amber,
Mhm.
number of Bitcoin that are rewarded per block is going to get cut in half. Okay, so if you're a miner, and let's say you were making $50,000 a day mining Bitcoin, because remember, you don't win every block. You're competing against all these other miners,
Mhm.
but the total amount of rewards is going to get cut in half. And
Mhm.
so, you know, if the price of Bitcoin goes up, that's great because even though the amount of rewards got cut in half, the price of Bitcoin doubled. But if it stays the same, and you're a miner, your revenue just dropped by 50%. Or if
Mhm.
the price of Bitcoin goes down, that's even worse because not only are the number of Bitcoins you're making every day goes down, but the prices come down. So
Mhm.
for me, I just find it easier to say, I'm just going to invest in the underlying stuff. Like to me, there's much more upside in investing in a project that there's zero, like, so if you buy a crypto token, I'm just going to use Render, which is a token that allows for the creation of a new artificial intelligence market. So it allows people to basically rent GPUs from other people, which are necessary for generative AI. That token has zero marginal costs in growing its market, right? Like the token is out there, it's creating a platform. It doesn't need to buy more computers. It's not raising any debt. It is just basically a platform business. And what we've seen for the last 20 years is that it's the platform businesses that become the most successful, right?
Mhm.
You have zero with the platform business for most cases, you have zero marginal costs. Like look at Facebook. You
Mhm.
know, they started in 2004. They had a couple of developers, engineers. Necessarily, it was a platform business. The company grew because more people just joined it. There was zero marginal cost for getting new people to join Facebook. Those are the kind of businesses you want to be in, which is why, one of the reasons why in crypto, if I have an allocation, I steer clear of the miners. I honestly, I've never
Mhm.
bought a miner myself,
Mhm.
because I just feel there's too much complexity and too many things that could possibly go wrong. Whereas, like, I can look at a protocol and say, here's the total addressable market at some point in the future. Here's where the demand is coming from. Here's the limited supply of the token. This is
Mhm.
why the price is going up. So I try to keep it as simple as possible, and I avoid the miners. I mean, if the price of the token, if the miners go up, it means the price of the token likely went up, right? So if you have a company like Hut 8 Mining, which is staking Ethereum,
Mhm.
uh, if Ethereum goes up, Hut 8 Mining go up, but I would just rather own Ethereum. I don't know.
Mhm. No,
Own Ethereum. If you can get 32 of them, you can create your own node and stake the network and get a reward, right? So,
true.
or you can stake Ethereum with one or half of Ethereum. It doesn't matter, and get that 4 or 5% annual return.
Okay.
That's the payout, not the capital. Like Ethereum could double or triple, but if you stake it, you will get paid basically a percent on the amount that you staked. I just don't want to confuse everyone by saying
No,
like Ethereum's only going to go up 4% this year.
no.
Okay.
No, that was good. It's what a comprehensive reply. Thank you, Ian.
Thanks for the question, Jamie.
Yes, thank you, Jamie. Okay, our last question that we like to address for this webinar is from William W. And William is subscriber to many services. Thank you for subscribing, William, so much. So on Coinbase Wallet. Ian, is there any risk to connecting your Coinbase account to a Coinbase wallet? There are a few meme stocks that I like to invest in, but they aren't traded on Coinbase. Thank you for.
Hmm. So let's explain the difference between Coinbase centralized exchange and Coinbase wallet.
Mm-hmm.
A Coinbase wallet will allow you to interact with different what are called Web3 properties, which basically means that it's the same thing as having a Phantom wallet or a MetaMask wallet. You can deposit cryptocurrencies in these, and you can go to a web page, connect the wallet, and the web page can see what you have in that wallet. And
Mm-hmm.
when you leave the web page, you can take those digital properties with you. Okay. Um, to me, this whole idea of wallets is going to reinvent the way that we interact on the internet. Because right now, Amber, every time that, you shop at Target online, they save all your data, right? Or every time, let's say you want to buy some new clothes at, I don't know, J. Crew or Vineyard Vines, you go to their website, you log into your account, and it's like they have everything saved, including your credit card information. But
Right.
imagine a world where all of that stuff, all your personal information is saved on a little wallet that has NFTs that represent, your credit card or represent maybe items that you purchased in the past. So, this is huge basically for uh, companies, because imagine that. So I don't know, two similar companies like J. Crew and Vineyard Vines, right? They sell the same market. They sell like polo shirts like I'm wearing. And imagine you go buy a bunch of things at J. Crew.
Right.
J. Crew could deposit an NFT in your wallet with the size of the shirt that you bought, the style of it, and personalize it for you. But you leave J. Crew and you take that digital aspect with you when you leave. If you go log into, like, let's say J. Crew's competitors, and you opt in with your data, they could automatically see your size. They could see what style of clothes you like to wear. And it could personalize, using AI, the entire shopping experience for you. Because right now, the way that we kind of interact with the web is not very personal, right? You go to a clothing store online, you got to click through to men's or women's, then you got to go to your style.
Yeah.
They could basically just show you the things that you most might want to be looking for, but do it in a way that also anonymizes you and gives you privacy of your data. So that's why I think this whole wallet thing is much bigger than, I know you want to trade some meme coins on it, but I think, it's going to be bigger. But so the question is, it is not dangerous to move crypto to, or link your Coinbase wallet to a Coinbase exchange. The only issue is that when you go to a website, you just have to make sure you don't get phished. Okay. So the rule of thumb I have is that I would not go around the internet with more money than I would, and money meaning like how much these tokens are worth, than I would be comfortable leaving my house with, right? So once you put stuff in a wallet and you go out to the internet, like, you can get pickpocketed pretty easily, you know? I mean, pickpocketing isn't so much a thing here in like the United States, but if you go to like Madrid or some like European cities, like, you can get pickpocketed in Italy, like, walk around Rome, like a unsuspecting tourist, like, you have risk of getting pickpocketed. Same thing with like these digital wallets. You put money into a MetaMask wallet or a Coinbase wallet, and if you interact with the wrong site, you can get drained. And it's not just unsuspecting newbies. I mean, there are like, I've gotten, I mean, I've lost, I would say, a significant amount of crypto clicking on the wrong site, thinking it was something else when it was, and hitting a button that I thought would actually give me, and I was purchasing an NFT, and really was just draining my wallet.
Oh
So
my.
you just have to be super duper careful with how much money. It's not a risk putting it in there. It's a risk going to some of these web properties. Um, and again, this is like a very nascent industry, Amber,
Yeah.
but eventually there's going to be much more safeguards in place. Very similar to, like, do you remember like in the early days of e-commerce? Remember, like, nobody wanted to store their credit card information online because like they were constant like scams. It's like that right now in crypto, but a lot of that security is going to be taken care of in the next couple of years, which is why, like, you want to get in this stuff now before like everything is totally mainstream. So I know I went off on a little bit of a tangent on Web3, but I see like my vision for this industry, I think, is a lot bigger than what people are focused on with like the meme coins and everything like that. Every company in the world is going to have some type of Web3 property that helps personalize an experience for a customer in a way that can be anonymized, and they can also port their data when they want to leave to go somewhere else. We're
And
taking back control of our data, Amber, whether
that's
you
right.
like it or not.
No, we need to. And the key word there is anonymized. I love that. So that's a good thing. Then we can safely do what we need to do with our e-commerce shopping. Well, Ian, that's a great reply to William. Thank you, William, for writing in. That's it for our questions this week, Ian.
Oh, awesome. Okay. We'll see you next week, I guess. Any questions, marketinsights@banyanhill.com. I think we're running the fourth halving webinar for one more week. So if you haven't seen it yet, please check it out. And you can hear more of my crypto commentary on that webinar.
That's right.
You
Stay
are
tuned.
so inclined. All right. Keep rolling with Fink, Amber.
Right. What is it?
Right.
Yeah, I'm totally with the Fink.
Down with the Fink. All right. Thanks, everyone.
Bye.
Take care. Bye.